This video will describe the contents of the Executive Summary Report, one of 6 reports provided by the Fiscal Checkup software. The focus of the Executive Summary is to summarize the overall findings in the other 5 reports. Before we look at the Executive Summary, it's important to understand the 3-phase process provided by Fiscal Checkup, which results in a financial roadmap for the business that is being analyzed. In the first phase, Fiscal Checkup conducts a deep assessment into all of the variables listed here, and we identify areas for profit and cash flow improvement. Once specific recommendations have been identified, the software monetizes the precise profit, cash flow, and business value that can be generated from implementing the improvements. In the valuation phase, Fiscal Checkup uses traditional valuation approaches to calculate the fair market value of the business. This is critical so we can measure future improvements against today's value. The third phase forecasts the business's financial performance over the next 3 years, assuming their current trends continue. After modifying any of the 7 areas listed here, you will clearly see how minor changes affect the future earnings, cash flow, and the value of the business. Our 3-phase process empowers businesses that want to thrive. All 3 phases are summarized in the Executive Summary. The Executive Summary begins with the top recommendations for improvement, as well as some other notes to consider. The top half of the page always lists the most critical recommendations, the ones with the greatest impact on cash flow, profitability, and business value. The bottom half of the page lists other comments on productivity, liquidity, free cash flow, and the return on invested capital. Page 2 contains a break-even analysis, a summary of the business valuation report, as well as some other important information. The chart on the top of page 2 explains the historic break-even points. The top line starts with the dollars to break even for the past several years. The second line converts that into days. To calculate the attainable values, Fiscal Checkup looks to see the lowest cost of goods sold margin where applicable and the lowest operating expense margin that has been achieved over the past 3 years. The software then calculates the variances if those margins had been attained. The break-even analysis continues with the historic profits and what the profit would have been had the company operated at the attainable level. The difference is what we call the unclaimed profit. The unclaimed profit is the company's excess cost that could have been profit. The unclaimed profit is also shown as a variance. The narrative below the table explains the data in the table. The bar chart shows what profits in green and what profits could have been generated if the attainable level had been achieved. This graph is a very important ratio that indicates a company's risk level. This ratio is the value of the future income stream of the company, the discounted cash flow, compared to the company's total liabilities. The narrative discusses the ratio of liabilities to the value of the company in more detail. This is an important ratio since it estimates the ability of the company to pay its liabilities with future cash flows. The final chart on page 2 summarizes the business valuation report, where the value of the company is calculating using the 5 traditional methods to value a business. The value calculated for various approaches is listed, culminating in the fair market value for 100% of the business. This valuation is based on what a buyer and a seller would negotiate for a business with access to all information. Page 3 is the profit driver review, which summarizes the entire profit driver report. The first chart on page 3 calculates the actual growth rate, the real growth rate, and the sustainable growth rate. It's part of a much larger discussion on revenue, margins, and growth rates that's found on the 6th page of the Profit Driver Report. The second chart and corresponding narrative on page 3 summarizes the entire cost of goods sold page from the Profit Driver Report. The third chart and corresponding narrative summarizes the 2 operating expense pages. The final chart and corresponding narrative summarizes the page dedicated to capital expenditures. Page 4 is the Cash Driver Review, which summarizes the entire Cash Driver Report. The first section on page 4 summarizes the full page containing the accounts receivable from the Cash Driver Report. The second chart and corresponding narrative on page 4 summarizes the inventory page. The third chart and corresponding narrative on page 4 summarizes the accounts payable page. These charts we are reviewing here and throughout all of our reports are only inserted into the report if they are applicable. Some businesses might not have payables, receivables, cost of goods sold, capital expenditures, inventory, and on. In those cases, other pertinent charts specific to a business will be shown and discussed. The final chart and corresponding narrative summarizes the page dedicated to discussing the cash conversion cycle, which is explained in great detail on a full page in the Cash Driver Report. Page 5 contains a 3-year forecast of the business based on the past trends of the company. Above the top of the forecast table, it always states whether the numbers in the table are based on the continuation of the past trends, otherwise known as the status quo, or based on new parameters. In a few slides, I will show you what it looks like when the parameters have been changed. The first 7 lines project what the income statement will look like through EBITDA. Lines 8 through 14 show how the current portion of the balance sheet will be impacted by the changes in the income statement, ending with cash after operations on line 14. Every business needs to first develop its operating forecast. That's why we only focus on the current assets and current liabilities portion of the balance sheet here. After any capital expenditures and the company's financing costs are deducted, the forecast shows the net surplus or cash needs of the business. Line 17, showing the cash surplus or needs, is a critical line for every business. It's wise to have an estimate of cash generated, but it's essential to plan for any cash shortfall. In today's environment, companies can have a challenging time trying to secure funding. This is where the cash needs have to be developed so the plans can begin to be made to be sure the company has the ability to borrow the needed funds. The bottom half of the forecasting table generates the collateral analysis for future loans. Fiscal Checkup reviews the revolving credit on short-term assets and the term credit on long-term assets, both of which are totaled on line 22, the total borrowing capacity of the assets. The existing debt is deducted to arrive at the available credit capacity on line 24. Lines 25 through 29 show key ratios that determine the bankability of the business. A company needs to have both the ability to borrow funds and the ability to repay the debt. On line 27, the debt service coverage ratio, which measures the company's ability to repay its loans, generally needs to be above 1.25 to secure financing from most lenders. Some lenders even want 1.5, which provides a 50% cushion. For those businesses that borrow money based on the cash flow of their business, like a service-based business, line 29 estimates the borrowing capacity based on those parameters. The final line in the forecasting table shows how the value of the business will be impacted over the next 3 years based on the financial performance above. This bar chart below the forecasting table shows the cash after operations, line 14, from the forecasting table. Also on the bottom of this page, this bar chart shows the business value from line 30 below the forecasting table. Whenever you change parameters for the forecast, above the top of the forecast table, it specifies the changes that have been made. In this example, the cost of goods sold has been reduced to 67.6% from the company trend of 73%. The capital expenditure budget has actually been increased to 1.8% from the company trend of 1.28%. And the inventory days have been reduced to 96.6 days from the company trend of 107 days. These changes are reflected in all of the appropriate lines in the table below, including the final line of business value, so a company can quickly assess the impact of proposed changes. Fiscal Checkup provides this forecasting tool so businesses can test scenarios to determine the impact of proposed changes and to ensure that the planned changes will in fact actually fix the problems that have been identified. Whenever there have been changes entered into the forward-looking forecast, this new page automatically appears. Note, this page does not appear if no changes have been made to the forward-looking forecast. The first bar chart shows how the EBITDA has changed from the continuation of the past business trends in gray and the new projections in blue. The second bar chart shows how the cash surplus or needs has changed from the continuation of the company's past trends in gray and the new projections in blue. The third bar chart shows how the debt service coverage ratio has changed from the continuation of the past trends in gray and the new projection in blue. Finally, the last bar chart shows how the business valuation would change with the old in gray and the new projection in green. Page 7 introduces two ratings systems developed by Fiscal Advantage. The D rating uses 9 key ratios that have an overall comparison to their industry. It is explained in much more detail in the Industry Comparables report. But as we summarize it here, we start with the 3 income-based ratios that you see here. We weight the ratios differently, in this case with the net profit margin having the greatest weighting. The ratios of the company are shown in this column, compared to the industry averages in this column. The weighted differential is then calculated because the first ratio, return on assets, makes up 20% of the score. If the company had equaled the industry average, the weighted differential would have been a 20. All 3 income-based ratios are totaled. If the company was exactly operating at the industry average, the total score would have been 100. When a company value is within plus or minus 10% of the industry, the final column shows the value in black. When the company underperforms by more than 10% compared to their industry, it's marked with a red flag. If the company outperforms the industry by 10% or more, it's marked with a green check mark. The identical process is followed for the 3 working capital ratios and the 3 leverage-based ratios. Finally, the 3 summary differentials are averaged for a total company score. If the company D rating is above 100, then the company is operating better than their industry on average for these 9 key ratios. If it's below 100, then the company is not up to industry standards for the averages of these 9 ratios. Fiscal Checkup takes 54 industry ratios and simplifies the industry comparison to this one overall number. The V rating analyzes 8 different factors that have been shown to influence the future viability of a company. For each factor, the company is rated as to how the most recent fiscal year compares to their own trend over the past several years, listed in the column entitled Compared to Trend. The second column, Compared to Industry, compares the most recent fiscal year to others in their industry. The final score to the right of each factor is the average of the two values. Remember the unclaimed profits from the break-even table earlier in this report? Well, the profit gap variance highlighted here evaluates the additional profits a company could have achieved if they had operated at their optimal level. The higher the rating, the better and more consistent the company's performance. Since this information does not exist for the industry, it's not part of the score for this variable. The market and company dynamics factor utilizes 5 of the most important subjective questions from the questionnaire, which are likely to predict future viability, such as market share and competitiveness of the company products. The V rating provides an estimate of the future viability of the company. Note that it's a full 1 to 100 scale. An average company would receive a satisfactory rating of 50 plus or minus 10%. The final page is a dashboard of 8 of the most important variables when evaluating the fiscal health of a business. The first graph compares the profit margins for the company to their industry for the past 3 years. Related charts and information can be found in the profit driver and the industry comparables reports. The growth rate and the sustainable growth rate are always shown. If the question regarding sales price increases was answered, then a third line, the real growth rate, is shown. The real growth rate represents the actual growth rate of the company after adjusting for price and cost of goods sold changes. The sustainable growth rate is the maximum growth rate that can be supported by the company's balance sheet. Any growth above the sustainable growth rate over the long term would require external sources of funds. More information can be found in the profit driver report. This chart shows how the profits are different from the new or incremental sales versus the old or base sales. The basis for calculating these values is explained in the profit driver report, but it's critical to understand the profitability of the new versus the historic sales. The values listed on this report are calculated only using the capitalization of earnings method. In the valuation report, a complete value analysis is performed with the customary methods in order to arrive at the fair market value of a company. See the valuation report for more information. Operating profit is after any cost of goods sold and operating expenses have been deducted from the revenue or sales, but before any other non-operating expenses have been deducted. Operating cash is the amount of cash from operations before other non-operating expenses. Over the long run, these two lines in this chart should be tracking together. When they don't, or there are wide variations, it's prudent to work with your CPA or business advisor to understand the reasons. In the event these two lines are not trending together, either the balance sheet is being depleted or profits do not support the company's cash flow. Again, this will be a problem if those conditions continue in the long term. For more information, see the profit driver report. This is simply the ratio of the amount of debt divided by the amount of equity on the balance sheet. This ratio varies by industry, so both the company data and the industry comparable data is presented. Additional debt is not necessarily bad as long as the net profit margin is greater than the interest rate on the debt, which is referred to as positive leverage, and the debt service coverage ratio meets the minimum standards. These forward-looking estimates are taken from the forecasted statement that we saw earlier. If the forecasted assumptions were changed, this chart will include those changes. This correlates to the 3-year projections in the executive summary. The projected debt capacity shows the total borrowing capacity of the company for the next 3 years. These amounts are detailed in the projection table earlier in this executive summary, and they're also covered in the lender's report. For each report, there is the ability for the user or the business advisor to add comments. If any were entered, they are listed on this final page of the report. Thank you for watching this video. If you have any questions or suggestions, please call or email us.